In our lesson on the anatomy of a candlestick, we went over what each component of a candlestick can tell traders about price action. But these components don't always look the same, and different combinations of a candlestick's color, shadows, and real body can reveal different information about the price action. Knowing how to interpret the various formations of individual candlesticks can help traders identify potential buy and sell signals for what's being charted. So let's get you up to speed. On any given day, you can imagine the stock market as a game of tug-of-war between buyers and sellers. When prices are on the rise, we say the buyers are in control. When prices are on the way down, we say that the sellers are in control. The color, shadows, and real body help traders determine who's in control in a given trading period. If you watched Anatomy of a Candlestick, you might remember that the tips of the shadows on either end of the candlestick represent the high and low prices of the day. It's the length of these shadows that tell us how much price rejection has occurred. Price rejection means the amount that the price of a stock dropped back down after rising or rose back up after dropping. The length of the upper shadow tells us by how far the buyers pushed the price up before sellers pulled it back down. And the length of the lower shadow tells us by how far the sellers pulled the price down before the buyers pushed it back up. Price rejection is essentially the refusal of either the buyers or the sellers to let the price go too far in one direction. The longer the shadow on a candlestick, the stronger the rejection. This is helpful for traders to know because the strength of rejection is one indication of the strength of the stock's trend up or down in that particular trading period. For example, a long lower shadow indicates a strong uptrend in the price action, suggesting that the price may continue rising. It's a common mistake for those who are new to technical analysis to think that long shadows are influenced by the volume of trades made at these prices. This is incorrect. The characteristics of the body and the shadows are based on price and price alone in this case. After a long lower shadow, if the real body is hollow, it means the buyers kept pushing the price up until it closed above the opening price of the day. The longer the real body, the more price rejection that occurred. If the real body is filled after a long lower shadow, it's an indication of a weaker price rejection by the buyers, since the amount by which they pushed the stock back up wasn't enough for it to close above the price at which it opened. Let's look at a few concrete examples that can come up on a stock chart to get a better sense of how to interpret these variations. A candlestick with a long real body and no shadows or minimal shadows tells us that there's little or no fight for control between buyers and sellers that day. Instead, paying attention to whether the candlestick is filled or hollow tells us who's in control for that trading period. If the long real body is hollow, it means that the closing price is higher than the opening price. The buyers are in control. If the long real body is filled, it means that the closing price is lower than the opening price. The sellers are in control. This formation is called a marubozu in Japanese, meaning bald head, a reference to the missing shadows. Now, let's say the candlestick has a long lower shadow and a small real body. The long lower shadow tells us that there was a significant price rejection. The sellers tried to pull the price down, but the buyers took back control. If the small real body is hollow, it means the buyers were just strong enough to push the price back up above its open. If it's filled, we could say their efforts fell short, and sellers ultimately won that round. This formation is called the hammer or hanging man. We'll see why a candlestick can have two different names in our lesson on multi-candlestick formations. Now, what if the small body was in the middle and it was so small that it appeared like a thin horizontal line? No real body tells us that the open and close are virtually equal. Equal shadows tell us there was a price rejection from both buyers and sellers. The buyers tried to push the price up, but the sellers brought it back down. And the sellers tried to pull the price down, but the buyers brought it back up. Unlike with a marubozu, hammer, or hanging man, there's no real body, meaning that neither the buyers nor the sellers were more aggressive that day in terms of moving the price. The candlestick will appear green or red in WebBroker, based on its closing price with respect to the closing price of the previous trading period. Green if it's higher, red if it's lower. The name of this formation is a doji, meaning mistake in Japanese, a reference to how rarely candlesticks open and close at the same price. This candlestick formation implies trader indecision. The buyers and sellers are at a standstill, making it difficult to predict which way the stock might move next based on this candlestick alone. Nevertheless, dojis are powerful tools that can help traders determine future price action. Watch our lesson on multi-candlestick formations to find out why. For more practice, pull up a candlestick chart of a stock in Webbroker and try to read it. Go to Charts and type in the name or symbol of a stock. You can also learn more about different candlestick formations under Research, Technicals, the education icon, then Short Term. For more information, check out our upcoming webinars and live masterclasses on technical analysis.